How much assets do you need saved up to retire confidently? Hi, welcome back to Money Not Math episode 180. I'm Drew Erickson with Five Stone Financial Group, where we specialize in turning a lifetime of hard work into a confident retirement experience. And today I'm discussing the different assets levels of $250,000 saved, $500,000 saved, $750,000 saved, and $1 million saved to show you what that could mean for those different income or those different asset levels as income in retirement to hopefully help you get a better idea of A, if you're already at retirement or in retirement, what could you be potentially spending comfortably? And or B, if you're still building up to your retirement, what do you need to get to retire confidently? If you're thinking it might be more than $1 million, well, hit me with a comment or a request and I'll extend that out to a larger number. But I thought it would be helpful to start at the 250, 500, 750, and $1 million numbers for today. So let's jump into it. All right, so I'm going to share my screen here. For those who are listening to the Spotify, I'll do my best to highlight the numbers to the best of my ability so that it's still valuable for you. Otherwise, if you have the opportunity, I recommend trying to find the video. So this person, I'm just calling them Mr. and Mrs. Confident. We're going to start out at the $250,000 level, and note this is in a traditional IRA. It's the same thing as a 401k and things like that. It is pre-tax or tax deferred. It is not a Roth or after tax. We can look at that in a future video if you think that would be helpful. But for today, we're going to look at $250,000 in a traditional IRA. Their goals, so they're both 67 years old. They just retired this year. We're not going to start with a monthly expense because we don't know. We're basing their long-term care costs, if they're going to plan around them, as if they're in long-term care for 2 years. In in-home care, there's in-home care, assisted living, nursing home. We're going to use in-home care because that's the most common care for 2 years, which today the average cost of long-term care in-home care is $75,504 per year. Now that obviously adjusts for inflation over time for each of them. As far as income goes, Mr. Confident has $2,300 of Social Security income, and that's just based on the national average for a 67-year-old male. Mrs. Confident has a $1,900 per month Social Security benefit. Again, that's dependent on the national average for a 67-year-old female. Everyone's Social Security is different. So this, again, this whole video is just conceptual. It's not perfect because everyone's situation is different. Everyone has different Social Security. Everyone has different asset levels, and where those assets are held makes a big difference. But hopefully that brings you value to just get a general idea. There's no ongoing savings or family worth discussing at this time. So let's take a look. So if they're both 67 years old and they're going to have 2 years each of long-term care coverage or expenses at the end of their lives, for an average of $75,504 a piece this year, that adjusts for inflation long-term. And Mr. Confident's life expectancy is 85, which is again just based on the Social Security website. The average life expectancy of a 67-year-old male is 85. The average life expectancy for a 67-year-old female is 87. So she's living to 87. And what that tells us is that if we want an 80% probability of success and about $249,000 remaining, a couple retiring with about $4,200 Social Security income can spend about $4,340 per month in their first year. And that is assuming we didn't do any Social Security optimization, any tax strategy optimization, just purely trying to keep it simple. These people could spend about $4,340 per month after tax their first year. That's after tax. That's important. And this is also assuming retirement spending smile. There's inflation adjusted spending where you just start with like a 4% rule and adjust for inflation. There's retirement spending smile, which says that on average, historically speaking, most retirees spend the most money in their first years of retirement. They're the youngest and healthiest they'll ever be. And then they decline their spending because they travel less. And then at the end of their retirement, they spend a lot more because of medical expenses like long-term care. There's also retirement spending stages, floor and ceiling and guardrails. We're going to use retirement spending smile because that's what I use for most of my clients with a guardrail component. And that gives us 80% probability of success. Just as an example, if we were to use inflation adjusted, which is kind of the most standard that I see for a lot of people who don't work with us, like just starting with a 4% distribution rule and adjusting for inflation, their probability of success would drop from 80% to 61. So how you spend your money in retirement and what strategy you use makes a big difference. And as I've outlined in other videos, your asset allocation, Social Security optimization, tax strategies also make a big difference. But I'm not going to get into that today. I just wanted to give you a frame of reference. So for this person, if they want to plan for 2 years of long-term care expenses for each of them, purely paid for by assets, they can spend $4,340 per month to have an 80% probability of success. If you haven't seen one of my videos before, you might be asking yourself, why 80% probability of success? Why not 100? Because when it comes to retirement planning, it's our belief that the goal, there's really two sides of the road per se that we want to avoid. The worst case scenario, or the one ditch that's the worst one to hit, is running out of money before we run out of breath. So we absolutely do not want a 0% probability of success, right? That's no good. That's fail. We do not want to run out of money, right? But on the other side, we also don't want to retire with more money than we need. We don't want to spend our whole retirement white knuckling our money in hopes we don't run out of money and never giving ourselves permission to enjoy life. And then all of a sudden we die one day and leave a lot more behind than necessary and got a lot less enjoyment out of our own lives than we could have. So we try to find a nice balance between not spending too much, but absolutely avoiding running out of money before we run out of breath. So that's where we find the 80% probability of success is a really good middle ground. If we get above 90%, we often give our clients permission to spend more. If we get below 70%, we start looking at ways to get more efficient or tighten the belt a little bit. So like I said, we use a retirement spending smile with a bit of a guardrails add-in. So it's a hybrid belief system with our clients. So we'll stick with 80% as the goal for the remainder of this video. So again, $250,000 in an IRA covering 2 years of long-term care for each spouse. They could spend about $4,340 per month after taxes confidently in retirement in their first year. Now, if they don't want to plan for long-term care expenses, either because A, they hope they don't have to deal with it, B, if they have to deal with it, they're okay with not leaving a legacy of assets behind, or C, they're going to do some proper estate planning to hopefully transition their wealth before they die to their heirs. This is what that could look like. And I'm going to show this for each asset level, whether you plan for paying for long-term care or don't plan for paying for it. So if they don't pay for long-term care, or they don't want to worry about paying for long-term care, either because they don't care or because they do proper estate planning, rather than $4,340 per month, they could spend $5,860 per month. Oh, wrong number. Sorry. $5,860 per month. That is $1,530 more per month. That's a big difference. So that just goes to show the extreme cost that long-term care can be at the end of retirement for some people. Now, from the most recent statistics I've seen, I believe it says 70% of retirees will experience a long-term care event at some point in time, and the average long-term care event is somewhere between 2 to 3 years. So it's a real issue that needs to be planned around, or at least be aware of it so you can do proper estate planning. And I'll just give you a quick insight as to why that is. So if we look at the end of this person's spending, you'll notice that this is them year one, they're spending 70,000. And then the last few years, when one of the two of them or both are in long-term care, that significantly spikes. And that's all because of the long-term care spending. So it's extremely important to be aware of how expensive long-term care can be for you if you don't do proper estate planning or don't have long-term care insurance or don't have some sort of a plan to address it. All right. So that's the $250,000 level. Now let's look at the $500,000 level. Quick recap: with long-term care costs, that couple can spend $4,340 per month. Without long-term care costs, that couple can spend $5,860 per month. So now we're going to jump that up to, rather than $250,000 in an IRA, let's put it at $500,000 in an IRA. Also, before I forget, this is based on a stereotypical 60-40 portfolio, 60% equity, 40% bonds. That's not necessarily what I would advise, but I find it's the most typical that people are aware of or hear about or read about. So I just want to make it as relatable as possible for you. If you want a more specific built strategy for you and your family, give us a call. We'd be happy to walk you through that and see what makes the most sense for you in your situation. All right, so at $500,000, this couple, so they can't quite spend that. This couple can spend $5,700 per month of after-tax income if they're accounting for long-term care costs and have 80% probability of success and median ending portfolio value of $341,000. If they don't account for long-term care costs, This couple can spend $7,020 per month. Again, about $1,320 more per month. Big difference. Whether you plan for long-term care or don't, or have proper estate planning or don't. It makes a massive difference in your plan. So that's the $500,000 level. Accounting for long-term care costs, $5,700. Not accounting for long-term care costs, $7,020. Now let's look at $750,000. At $750,000, and accounting for long-term care, they can spend $6,800 per month. Again, which is in case you didn't notice, at $500,000 of assets and not accounting for long-term care, they can spend $7,020. At $750,000 of assets and accounting for long-term care, they can only spend $6,800. So $250,000 more assets, but accounting for long-term care is actually more expensive. So it's amazing how much of an impact long-term care insurance costs or impacts you. So again, $750,000 accounting for 2 years of long-term care each. This couple could spend about $6,800 per month of after taxes their first year of retirement. Now, if we don't account for long-term care, this couple could spend about $7,990, about $1,190 more per month if they don't account for long-term care. All right, so $1,600 with paying for long-term care for 2 years each, about $7,990 if they don't pay for long-term care for 2 years each, because due to not caring or proper estate planning. All right, so now let's see what $1 million gets us. $1 million in retirement. Again, all of this assumes the same $4,200 combined Social Security benefit. $1 million in retirement, we can, with accounting for long-term care for 2 years each, we can spend about $7,900 per month after taxes. The after-tax part is very important because, as you know, the higher your income and asset level, the more taxes you pay, right? Which is why if you look through these numbers, it's not a perfect scalable increase from 250 to 500 to 750,000 to $1 million of assets is regarding how much more income you can spend. So at $1 million in an IRA to cover 2 years of long-term in-home care costs at the last 2 years of these two hypothetical people's retirements, they could spend $7,900 per month of after-tax income in their first year of retirement. If they don't account for long-term care, they could spend $9,010 per month in their retirement. About $1,010 difference. Pretty big difference, right? So that's a big thing for you to ask yourself is we got to know what if you're just entering retirement planning, or if you currently work with someone but you don't have a very clear plan or strategy, the first thing you have to understand is what do I have? B, what do I want? C, what do I need? And D, is what I have going to get me to where I want and where I need? If it's not, what's the gap and what do we need to do to close it? All right, and that's what we do for our clients. We help them figure out what do they have, what do they want, what do they need, what's the gap, if any, and how do we close that gap? And if we don't have a gap to close, or even if we do, how do we optimize what they have? Because as I've shown here and in many other videos, there's a lot of little things that we can do to make the same amount of money create a lot more income and wealth for you. All right, so that's Money Not Math episode 180, asking what amount of retirement assets do you need to retire confidently for you and or your spouse if you're married. Keep in mind, Social Security varies dramatically for everyone. Before tax assets like an IRA make a big difference compared to after tax assets like a Roth IRA. Non-qualified accounts make a difference as well. So this is just a hypothetical situation, but hopefully it brought you value. If it did, please subscribe to my YouTube page, comment if you with a question, or share it with a friend, and reach out if you have interest in scheduling a meeting or a specific request for a future Money Not Math conversation. Disclaimer, this content is not legal, tax, or investment advice. Please see a qualified professional regarding your personal situation. Thank you so much for your time and hope you have a wonderful day. Bye.